Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So now I'm going to start the next topic in the subject accounting, that is capital and revenue expenditure. In the last videos I have completed trial balance, irrecoverable debt and incomplete records. So hope my regular viewers are watching all the previous videos, got acquainted, full command on the topics of trial balance, irrecoverable debt, incomplete records. Now I'm going to start the next chapter, capital and revenue expenditure. So before starting the explanation, take a screenshot of the notes which I have written so that you can be able to maintain a permanent note, so that before examination you can be able to review, revise and get a good command on the topic. And remember one thing, the theory is very important. If you, with full concentration, if you watch the theory video, definitely you don't find any problems while doing the main problems and short questions. You will not find any difficulty. So first of all, take a screenshot, then I'll explain all the points. Now see, capital and revenue expenditure. So in this video I'm going to explain you about the meaning of capital and revenue expenditure, the meaning of capital and revenue receipts, then examples of capital and revenue expenditure and capital and revenue receipts, then differences between capital and revenue expenses, then impact of capital and revenue expenditure on income statement and statement of financial position, then impact of wrong treatment of capital expenditure or as revenue expenditure or vice versa, and the impact of wrong treatment of capital receipt as revenue receipt or vice versa. So these are the things I'm going to explain you in this video. So watch the video till the end. First of all, I'm going to explain you about capital expenditure. Capital expenditure is the expenditure incurred on acquiring a non-current asset. So in a business, two types of assets are there: current assets, non-current assets. The current assets are inventory, trade receivable, cash at bank, cash in hand. And the non-current assets are building, machinery, equipment, furniture, vehicle. So these are called non-current assets. So any expenditure incurred on acquiring a non-current asset or adding some non-current asset to the existing non-current asset. Add to the value of an existing non-current asset. This is the meaning of the term capital expenditure. Simply, expenditure incurred on acquiring a capital asset or non-current asset. That is called capital expenditure. Examples of capital expenditure: cost of acquiring a non-current asset. First of all, acquiring means purchasing. The cost incurred in purchasing a machinery, in purchasing furniture, in purchasing vehicle, in purchasing equipment, the cost is called capital expenditure. Secondly, cost of bringing non-current asset to the business. Any expenditure incurred in bringing the non-current asset to the place of business. So incidental expenditure incurred to bring the asset to the business, that is also capital. The legal cost on buying premises. Normally when a building or premises is purchased, some legal expenditure will be incurred like registration charges. These are also capital expenditure. Next, the carriage inwards on machinery or equipment purchased. When machinery or equipment is purchased, some carriage inward is incurred. So whatever carriage inward incurred to purchase the machine, equipment, that is also capital expenditure. Installation of the non-current asset. Once non-current asset is purchased, it has to be installed. For installation, some charges will be paid. That is called also capital expenditure. Upgrading a non-current asset. If the non-current asset has to be upgraded by incurring some expenditure, that is also capital expenditure. So these are the examples of capital expenditure. What are the features of capital expenditure? Appears in statement of financial position and tends to last long for more than 1 year. First point is, the feature of capital expenditure is the capital expenditure will be taken to the statement of financial position, and the capital expenditure will give the benefit to the business for more than 1 year, for a long period of time. Expenditure will be incurred in 1 year, but the benefit will accrue for a long period of time. That is the feature. Now, revenue expenditure. So I explained you the meaning, then examples, then features. Now, revenue expenditure. Expenditure incurred on day-to-day running of business. The recurring expenses, day-to-day expenditure incurred to run the business, operating expenses incurred to run the business are called revenue expenditure. This capital expenditure is a non-recurring expenditure because every now and then we will not spend the money. Very rarely we will spend the money on capital expenditure. But revenue expenditure is a recurring expenditure. Every now and then we have to make the payment. Do not add any value to the current asset, to the non-current asset. By incurring revenue expenditure, the value of non-current asset will not increase. Simple example I'll give you. Vehicle cost. A car is purchased for the business. So purchasing a car is a capital expenditure. Now after purchasing the car, some repairs and maintenance expenditure on car is incurred. So this repairs and maintenance is recurring expenditure. So it's a revenue expenditure. But do the value of vehicle increase by incurring the repair and maintenance? No. The value of vehicle will not increase, but it will give more service. So by incurring expenditure on repair and maintenance, we can be able to effectively utilize the assets, non-current assets. That means this revenue expenditure will not add any value to the non-current asset. Then it is a recurring in nature. That means every now and then it will be incurred. Then incurred to maintain the non-current asset. This revenue expenditure is incurred mainly to maintain the existence of non-current asset. If this revenue expenditure is not incurred, the non-current asset cannot be utilized, cannot be used. It will break down. So these are the expenditure incurred called revenue expenditure. Now examples of revenue expenditure, so many examples are there. First, payment of salaries, wages, rent, printing and stationery, etc. Wages and salaries will be paid every month. Rent will be paid every month. Printing and stationery every now and then incurred. Then repairs to vehicle or machinery. When we use the vehicles or machinery, frequently we have to spend the money on repairing. That is also a recurring expenditure, revenue expenditure. Then heating and lighting, electricity expenses, etc. So many expenses are there which are recurring, which are revenue expenditure. Now features. By incurring revenue expenditure, the profitability is maintained. By incurring this revenue expenditure, the profitability will be maintained. Otherwise, profitability will fall down. By incurring capital expenditure, the profitability may increase. But by incurring revenue expenditure, it will be maintained. The next one is gives benefit only in a year. By incurring capital expenditure, the benefit to the business will accrue for a long period of time. Whereas by incurring revenue expenditure, the business will get the benefit only for 1 year. That is a feature. Now, capital receipt. So far, I have explained you about capital expenditure and revenue expenditure. Similarly, we have capital receipt and revenue receipt. So, what is capital receipt? These are non-recurring receipt. Every day or every month, we will not get this receipt. Very rarely we will get the receipt. Non-recurring receipt is called capital receipt. Examples of capital receipts are sale of a non-current asset. If a non-current asset has become old, business will sell it off. Sale of non-current asset. So any money realized on sale of non-current asset is a non-recurring. So it's a capital receipt. Similarly, bank loan taken. So every now and then we will not take the bank loan. Very rarely the business will take a loan from bank. So it's a non-recurring. So capital receipt. Amount invested by the owner. Every now and then owner will not make the investment. So very rarely it will make. So these are the examples of capital receipt. What are the? Sale of non-current asset, loan taken from bank, or amount invested by the owner in the business. These are called capital. Revenue receipts, these are the running receipts. Running receipts means the business will receive the amount regularly, continuously. So examples of revenue receipts are sale of goods. The business will sell the goods every now and then, every day. So revenue realized by selling the goods is the revenue receipt. Similarly, interest received, commission received, dividend received, rent received, all these are the revenue receipts. Now, impact on financial statements. Why we have to distinguish between capital and revenue? It is very much necessary to prepare the financial statements. Two financial statements are there: income statement and statement of financial position. Income statement will give the profit of the business. Profit earned during the year, during the period, can be known by preparing income statement. Assets and liabilities can be known by preparing statement of financial position. Every business will make a statement of financial position and income statement at the end of the year. So without distinguishing between capital and revenue expenditure, we cannot make the income statement and statement of financial position. That shows the importance of differences between between revenue and capital expenditure. So revenue expenditure and revenue receipt, remember, revenue expenditure and revenue receipt both will go to income statement, whereas capital expenditure and capital receipt will go to statement of financial position. Remember, whatever I am explaining, if you listen, if you watch with full concentration, then definitely you will not find any difficulty while solving the problem in the next video. So complete problems are based on this theory. So whatever I am explaining, keep it in mind. I have explained you the examples of capital expenditure, examples of revenue expenditure, examples of capital receipt, revenue receipt, and where this capital expenditure and revenue expenditure will come. So revenue expenditure and revenue receipt will be taken in income statement. Capital expenditure and capital receipt will be taken in statement of financial position. Now, differences between capital and revenue expenditure. So very frequently theory question will be asked, what are the differences? Many differences are there. The first difference, capital expenditure non-recurring, just now I told you, whereas revenue expenditure is recurring, which will recur again and again. Then capital expenditure, buying a non-current asset. Capital expenditure is incurred on buying a non-current asset, and revenue expenditure is incurred for running the day-to-day expenses. The running day-to-day expenses are called revenue expenditure. Then capital expenditure will be taken in statement of financial position. Revenue expenditure will be taken in income statement. Then last one, capital expenditure benefit for more than 1 year. When a business incurs capital expenditure, the business will get benefit for a long period of time. Example, a vehicle is purchased during the current year by paying a certain amount. For example, for $50,000. The business purchased a vehicle by paying $50,000. So expenditure is incurred during the current year, but we will get the benefit from the vehicle for a number of years. That is the nature of capital expenditure. Revenue expenditure, the benefit will expire within 1 year. Example, when we pay for electricity, that means the benefit of this electricity will expire within 1 year. When we pay salaries, we'll get the services of employees only in 1 year. When we pay printing and stationery, we'll get the benefit only in 1 year. So revenue expenditure benefit 1 year, capital expenditure more number of years. These are some of the differences. Now, impact of wrong treatment. If an accountant has committed an error in treating capital expenditure as revenue expenditure or revenue expenditure as capital expenditure, what will be the impact? The first thing you have to remember, the income statement will not show the correct profit. The income statement will not show the correct profit. Similarly, statement of financial position will not show the correct financial position of the business. The assets and liabilities are incorrect, not reliable, if we do not make a distinction between capital and revenue. So that's why if an accountant, if a business wants to find out the true profit and true financial position, the business must clearly distinguish between capital and revenue expenditure. So what is the impact? Impact of wrong treatment. Wrong treatment of capital expenditure as revenue expenditure. Suppose a business has incurred expenditure on purchasing furniture. $50,000 worth of furniture purchased. It's a capital expenditure. But the accountant has committed a mistake. He has taken that $50,000 purchase of furniture in income statement, in revenue account. Then what will happen? The profit will come down. The profit will be understated. The profit will come down because when we purchase furniture, it's a capital expenditure. It should be taken in statement of financial position. But the accountant has treated that capital expenditure by mistake as a revenue expenditure. So profitability will be profits will be understated. So here you can see profit understated and non-current asset also understated. Because we have purchased furniture, we have not taken furniture in assets. Not taken furniture in assets. So assets will show less, understated, and profit will also be understated. This is the treatment if capital expenditure is treated as revenue expenditure. And if revenue expenditure is treated as capital expenditure. Suppose some revenue expenditure is incurred. Example, repairs to machinery. Repairs to machinery is a revenue expenditure, but by mistake the accountant has treated as a capital expenditure. Then what will happen? The profit will be overstated because one revenue expenditure is there that is not taken in revenue account. The profit will be overstated. And what will happen? The assets will be understated. The wrong treatment of revenue expenditure as capital expenditure. Profit will be overstated and non-current asset will also be overstated because repairs should have been debited to income. But by mistake these repairs are taken in machinery. Then machinery account will increase, balance will increase. So that is the effect. Last one, wrong treatment of capital receipt as revenue receipt. One capital receipt is there, by mistake it is treated as revenue receipt. Example, bank loan taken. $10,000 bank loan taken, it is a capital receipt. But the accountant has treated as a revenue receipt. He has taken in income statement. Instead of taking this in statement of financial position, the accountant by mistake he has taken in income statement. So income will increase, profit will increase, the profit will be overstated. And wrong financial position. Because one capital receipt is there, we have not taken capital receipt in statement of financial position, we have taken in income statement. The profit will be overstated, their financial position will also not be true. Similarly, wrong treatment of revenue receipt as capital receipt. Some revenue receipt is there, but unfortunately that revenue receipt is treated as a capital receipt. Then profit will be understated and financial position will also not show the true and fair picture of the business accounts. That's all. This is the end of the theory part of capital and revenue expenditure. So in this video, I have explained you the meaning of capital expenditure, the meaning of revenue expenditure, then capital receipt, revenue receipt, examples of capital expenditure, revenue expenditure, examples of capital receipt, revenue receipt, differences, then impact of this capital and revenue expenditure on financial statements, and what is the impact of wrong treatment that I have explained. So inshallah, next video I'll start the problems on this capital and revenue expenditure.